Here's the sharp move traders are waking up to on Tuesday, August 18, 2026. The euro has fallen back below 1.1600 against the US dollar, trading near 1.1575 in early Asian hours. That matters because 1.1600 is not just a round number, it is a psychological line that has acted as both support and resistance for months. The immediate trigger is renewed fear of direct conflict between the United States and Iran. When war risk headlines hit, money rushes into the US dollar as the world's default safe haven, and the single currency gets sold. This is not a quiet technical drift lower. It is a flight to safety. The latest fall follows weeks of mounting tension rather than one isolated headline. The US-Iran standoff has kept a war risk premium in oil markets, pushing Brent crude to a two-week top near $90 a barrel. Higher oil prices change the inflation outlook. They push up transport, energy, and manufacturing costs, making central banks less likely to cut rates quickly. Markets are now reviving bets that the Federal Reserve could hike, not cut, because inflation risks are back. For the euro, this is a double hit. The Eurozone is a heavy energy importer, so expensive oil weakens its trade position, while a more hawkish Fed makes the dollar more attractive. Earlier uncertainty over a US-Iran peace deal also pushed euro to US dollar toward 1.1450 in late June. The impact today goes beyond a currency chart. A weaker euro makes imports, especially oil and gas priced in dollars, more expensive for European households and businesses, feeding into petrol prices and broader inflation as growth stays fragile. Gold has slipped below $4,100, not because investors are calm, but because rising US rate expectations increase the opportunity cost of holding non-yielding bullion. The Indian rupee is ticking up on likely central bank intervention, showing dollar strength is pressuring currencies globally. For European exporters, a lower euro offers some competitiveness, but that edge is muted when the driver is war risk and an oil shock rather than stronger demand. The near-term direction depends on two things: any escalation or de-escalation around Iran, and whether oil prices stay near $90 or spike higher. If 1.1600 fails to recover quickly, traders will look toward the next support zone near 1.1450, which marked the June lows during the last peace deal scare. But this is not a one-way bet. If Tehran and Washington signal renewed negotiations, oil could drop sharply and the euro could rebound just as fast as it fell. War risk headlines are unpredictable, so expect volatility, wider trading ranges, and defensive positioning into any Fed or ECB commentary this week. The takeaway is this: euro to US dollar below 1.1600 is not simply a dollar story. It is a war risk and energy story. As long as the Strait of Hormuz remains a flashpoint and crude stays elevated, the euro will struggle to find sustained upside. For traders and businesses, watch whether 1.1575 holds as today's low and whether the pair can reclaim 1.1600 on any peace headlines. If it cannot, the path toward 1.1450 becomes more credible. Before any technical indicator, keep an eye on oil prices. They are leading the currency market right now.